Okay, we'll be starting with the revision of income from house property. When will any income be charged under this head? Only when these three conditions are satisfied. What are the three conditions? First one being there must be a building and there can be a land which is appurtenant thereto. The land appurtenant thereto meaning a parking lot or a garden which is attached to the building. The second condition being the assessee must be the owner of the property. He can be a legal owner or a deemed owner. Who is a legal owner and who is a deemed owner? Say, for example, a father had transferred his piece of land and a building for his son without any consideration. In this case, this land and building is legally in the name of the son, but the deemed owner of the property will be the father. And the third condition is the property must not be used by the SSC for own business or profession. He can be careful that this property can be let out to any other person and they can use it for their business. But the SSC must not use the same building for his business. Only when these three conditions are satisfied, any income from this house property can be charged under this head. Then we'll move to what are the different kinds of house properties. There are three different kind of house properties. The first one being self-occupied property, second one is deemed to be let out property, and third one is let out property. What is a self-occupied property? It's a property wherein you own the property and you are using the property as well. The Income Tax Act provides you that you can have this kind of property of maximum two number. If you have any other property other than this, which you are not letting out, but you own the property, that will be called as deemed to be let out property. The that third type of property is known as let out property, wherein you own the property, but you are giving this out on rent to some other person. He can use it for any other business or profession. After this, if we go to computation of taxable income from any of these kind of property, in the first case, we'll be seeing self-occupied property, wherein you don't have any rental value in this case. In your NAV, that is net annual value, the amount will be nil. Only you will get a deduction of pre-construction period or current year interest. That is your interest on borrowed capital. And you should be aware that this kind of interest deduction is not available if you are taking alternative tax regime. This will be available only if you are in normal tax regime. The second one is deemed to be let out property. Here you will be taking the municipal value as well as the fair rental value. Whichever is higher is known as notional rent. And this notional rent is then compared with the standard rent. Whichever is lower amongst these two will be taken to the next step, which is called as expected rent. And this will be compared with the actual rent. What is an actual rent? There will be, say, for example, you're charging 10,000 rupees as rent per month. Then 1,20,000 will be your annual rent. And you are going to reduce any unrealized rent amount from this annual rent. What is an unrealized rent? Say, for example, you have a tenant in this property and you were asking the tenant to give you the rental amount and he has not given it yet. But you have made all the efforts to collect that rent from him. That is called as unrealized rent. If there is any such unrealized rent, you're going to reduce the same from the annual rent and that will give you the actual rent. This actual rent, for the case of deed to be let out property, you will not be having any actual rent. So whatever is your expected rent will be taken to the next step. And there will be no vacancy loss as well because you're not letting out this property. The same expected rent will be taken as gross annual value for your case. And if you have paid any municipal tax, that is owner paying the municipal tax during the current period, only then such deduction is available. After this, there's something called a standard deduction of 30% of NAV. That is whatever is the value you're getting here, the 30% of that will be given a straight deduction. This is the standard deduction. And the next one being interest on borrowed. That may be pre-construction period interest or current year interest. We'll study about these two concepts a little later. Whatever is the value you're getting right after deducting all these things, that will be called as taxable income from house. The third type of property being let out property. Here you have actual rent as well as the remaining other kind of rent as well. If in the question any of these kind of rent is not given, you're just going to place this value. Say for example, in the question, right now fair rental value is not given, but municipal value is given. Here, you're going to take the municipal value for the next step. You're not going to ignore the question just because they have not given you fair rent value. You're still going to consider the municipal value as notional rent. And then you're going to calculate further. Here you will be having municipal rent and fair rental value, whichever is higher is taken to next step, which is called as notional rent. Then you're going to compare the same with standard rent, whichever is lower is taken to the next step, that is called as expected rent. Then it is compared with actual, whichever is higher is called as gross annual value before vacancy loss. Say for example, I am owning a property. I have let it out to someone else, but that person has stayed only for 11 months. Then my actual rent would have been, the annual rent would have been 1,20,000. But I have a vacancy loss of 1 month, that is rupees 10,000. So if I reduce the same thing, the gross annual value I'll be getting as 1,10,000. Then here, only in the case if the municipal tax is paid by the owner, I'll be getting a deduction. Say, for example, if tenant had paid the municipal tax for this property, I won't be getting a deduction. I, being the owner of the property, won't be getting the deduction. Then, will this municipal tax be only regarding the current period? No. Even if this municipal tax is regarding some previous year, but I'm making the payment during the current period, even then such deduction is available. Then whatever value I'm getting after this will be called as net annual value. Then again, same thing, I'll be having the deduction that is 30% of NAB, and the second one being interest on borrowed capital, that may be pre-construction period interest or current year interest. The net amount after I deduct all these things are called as income from house property. And then moving on, we'll see what is interest on borrowed capital. There's something called as current year interest, and there is something called as pre-construction period interest. First, we'll be seeing current year interest. And here I'm making a bifurcation between let out property and self-occupied property. With this let out property only, the let out property is also taken into consideration, because here, when I'm seeing these two categories, I have no limit regarding the deduction which I'm going to get here. Say, for example, even if it is 4 lakh rupees, I'm going to get a reduction of 4 lakh. But when it comes to self-occupied property, the maximum deduction I can ever get is 2 lakh rupees. This 2 lakh rupee deduction is available only when these conditions are satisfied. If these conditions are not satisfied, then the deduction is limited to only rupees 30,000. Here, the total interest deduction will be limited to only 30,000. But if following conditions are satisfied, then this deduction amount can be up to rupees 2 lakh. Let's see what the conditions. The first condition is the loan should be taken after 1/4/1999. The second condition should be the loan can be taken for the sake of construction or for the sake of purchase of the building. Here, I can't claim a deduction of interest if I've taken the loan for the purpose of reconstruction or repairs or something like that. Third condition, if I've taken this loan for the sake of construction, then this construction should have been completed within 5 years. These are the three conditions. If these three conditions are satisfied, only then the deduction here will be maximum of 2 lakh rupees. If not, then the deduction will be only rupees 30,000. Then the second kind of interest is pre-construction period. What is this pre-construction period interest? Say, for example, if you're constructing a building, the construction would take a considerable amount of time. Say, for example, 1 year or 2 years. Whatever happens to that interest, ideally won't come because once the building is completed, only then I can take it as a building which is eligible for deduction. In this case, for pre-construction period interest, I'm going to see when was the loan taken. The date of taking the loan will be called as a start date, and the end date, that is whenever you have finished the construction, then the end date which I'm going to consider for this pre-construction period interest would be 31st of March of previous year as to whenever you have completed the construction. Say, for example, if you have completed the construction on 31st of May 2021, then the end date would be 31st of March 2021 for my case. Here, what is pre-construction period interest? I'll be getting 1/5 of deduction for 5 years once I complete the construction. This is sum up whatever happens in income from house property.